Chapter 4, GDP. Section 4, GDP growth cycles. Real GDP usually trends higher over time, but it almost never moves in a straight line. Instead, it tends to pass through repeating periods of faster growth, slowdown, decline, and recovery, which is why cycle awareness matters when you read economic data. Those ups and downs are often described as four phases. Expansion is when output and demand are rising, peak is the high point, contraction is the decline from that high, and trough is the stage where weakness bottoms out. And a new recovery begins. During expansion, hiring, incomes, and spending usually improve together, and businesses respond by producing more and investing more. As the cycle matures, growth can still be positive, but capacity gets tighter, labor becomes harder to find, and rising costs often signal that the economy is nearing a peak. In contraction, the slowdown spreads more broadly across the economy. Businesses cut production and investment, hiring weakens, consumers grow more cautious, and by the time the trough arrives, the key change is that the decline stops getting worse and starts to stabilize. Cycles happen because the economy feeds back on itself. Rising income supports spending. Stronger demand encourages hiring and investment. But if inflation builds and borrowing costs rise, those same forces can reverse and slow growth. Recovery often starts before the GDP numbers make it obvious. As demand cools, price pressure can ease. Interest rates may become less restrictive, and gradually improving confidence helps spending and production begin to turn back up. One reason turning points are so difficult to call in real time is that GDP arrives with a delay and early estimates are often revised. By the time a peak or trough looks clear in the data, the economy may have already been moving in the other direction for a while. That is why investors and analysts watch leading indicators for earlier clues. Jobless claims, new orders, confidence measures, housing activity, and business surveys can all shift before GDP does, especially when several of them begin moving together. The pandemic was a vivid example of how fast a cycle can turn. What looked like a late-stage expansion in 2019 became an abrupt contraction in early 2020, and then policy support plus reopening helped drive a rapid recovery after the trough in April. The main takeaway is to stay broad and patient when reading the cycle. One weak quarter does not guarantee a full turn. Not every peak leads to a severe recession, and because GDP can be revised, the best approach is to weigh multiple signals rather than rely on any single report.